Now looking at the performance of the NSE 6 months into 2012, it's up 16.63%. Pretty impressive pretty impressive first half, would you say?
Yeah, I think it's actually performed better than some markets that we normally look at. In East Africa, it's underperformed Uganda, which has done about 20% in US dollar terms. It's done much better than Tanzania and Nigeria as well. I think Egypt is right up there at about 25%. So looking at it, it's not too bad a performance for the first half of the year, especially considering that a lot of investors had bearish views as we came in of what would happen and the sort of macro environment and how that would play out into the equities. From multiples perspective, the PE still looks attractive. It's much lower than what we're seeing in. It's about 9.65, which is much better than what we're seeing in Nigeria, which is high relatively, about 11, 12 times. So still looks fairly attractive, and there's more value in the market.
In the market now, we are heading into the second half of the year. Could we perhaps see this type of performance being continued?
I think I'd be cautious to sort of try and extrapolate the performance we've seen going forward. I think two things are key. One of them has been the volumes that we've seen. I think a lot of local investors are still playing out of the market, focusing more on fixed income side than equities. So foreign investors really have had a field day, and they're the ones who have been really driving up the market. If you look at the sort of stocks that have driven returns over the last, I think, 6 months, again, the stocks that would be associated with foreign institutional investor interest. So whether we're actually going to see this performance carry on into the second half of the year, I think you'd probably expect that profits would be taken at some point. I'd expect to see some resistance at about the 3,800 level. And if we're able to break that, then we're probably looking at about 39,420 heading towards the year's end.
Looking at a stock like Kenyan, it has been in the news lately given that takeover bid by Puma Energy. It came out with a cautionary statement in yesterday's trading session. The company is pretty positive that this bid will go through.
Yeah, I mean, if you look at sort of the environment that we're in right now, it probably resembles what we were seeing in 2009, 2010. A lot of these large players like to do M&A deals when oil prices are fairly high, and the outlook looks promising. And again, right now it's probably easier to get financing because of the sort of interests that we have in the developed markets, where they could probably obtain their financing. So I think as far as the prospects for the deal going through, that looks pretty much sewn up, but we still are waiting for them to finish their due diligence in July. Probably one thing that I'd probably think about right now is the sort of divergence that we've seen between the stock price and the price of crude oil. Kenyan shares have had a very positive and strong correlation with oil prices. Whenever the oil prices goes up, Kenyan shares react that way. But if you look at it over the last 2 or 3 months, there's been a bit of divergence, and perhaps one would have expected that there'd be a bit of a correction in the share price. You'd probably believe that one of the reasons why that has not happened is because investors are pricing in a takeover premium. But in the event that this deal would actually not materialize or go through, then you would expect a sort of sharp correction on the share price.
Let's touch a bit on the Kenyan shilling. Looking at the shilling sitting at 84.14 at this stage, but really driven lower by energy companies coming into the market due to that month-end demand. Your thoughts on the shilling going forward?
My thoughts on the shilling, I think two things are key going forward. Probably one would be the MPC meeting that is expected in 10th of next month, and how traders are going to position for that, with some schools of thought saying it's about time we had a rate cut, and that's actually going to come through in the next month. Obviously, if that were to materialize, then you'd probably see a period of weakness for the shilling, especially as rates come down. Something else, again, has been the sort of liquidity situation that we've had in the money markets and the interbank markets. The shilling did fairly well last week, and part of the reason for that was because interbank rates were averaging between 17 and 20%. As of, I think, yesterday, day before, it was about 16%. So we're probably going to see the central bank coming back to stabilize the shilling. So for the short run, you'd probably expect it to, stay stable at these levels, but I think there's a bias to weakness. We're probably looking at 86.95 heading towards the MPC meeting because of, again, seasonal factors that normally kick in towards the end of the month. Okay.
We had that 182 Treasury bill auction in yesterday's trading session. What kind of rates did we see coming through as well as demand?
Yeah, I think the yield on the 1H2 was up about 23.4 basis points to about 11.091. And again, the reason for that, it was also supported by very low demand. Part of the reason, of course, is because traders are preferring to lock in their cash in the term repos that the central bank is doing, which offer relatively high yields for a much, 1 month is probably a good time to lock in at about 16-17%. I think, the sort of reason why we're seeing this, again, sort of uptick on the yields for the shorter term papers, 91, 1H2, the Treasury bill, is because they actually fell much faster than they should have if you were to consider the sort of historic relationship that they've had with inflation. So I think, just based on our model, we think the 91-day Treasury bill right now should have been at about 11.7, 11.9 levels. And you would expect, therefore, that there's going to be, again, some sort of, upward correction, and it will approach these levels.